This video provides an overview of the major concepts covered in Chapter 18, Bank Regulation. Because banks rely on funds from depositors, they're subject to regulations that are intended to ensure the safety of the financial system and maintain public confidence in that system. Chapter 18 includes 8 learning objectives. First, to describe the regulatory structure of the U.S. banking system. Second, to describe key regulations imposed on commercial banks. Third, to explain capital requirements of banks. Fourth, to explain how regulators monitor banks. Fifth, to explain the issues regarding government rescue of failed banks. The sixth learning objective is to discuss government funding provided to banks during the credit crisis. Seventh, to describe how the Financial Reform Act of 2010 affects the regulation of commercial bank operations. And finally, to describe bank regulation in other countries. Let's start with regulatory structure. The regulatory structure of the banking system in the U.S. differs dramatically from that of other countries. Because it includes both federal and state regulatory systems, it's often referred to as a dual banking system. National banks are regulated by the comptroller of the currency, whereas state banks are regulated by their respective state agencies. Banks that are insured by the Federal Deposit Insurance Corporation, or FDIC, are also regulated by the FDIC. Commercial banks can either be independently owned or owned by a bank holding company, or BHC. The next learning objective relates to regulation of bank operations. Banks are regulated according to how they obtain funds, how they use their funds, and the types of financial services they offer. The FDIC preserves public confidence in the U.S. financial system by providing deposit insurance to commercial banks and savings institutions. The specified amount of deposits per person insured by the FDIC is currently $250,000 as part of the Emergency Economic Stabilization Act of 2008, which was intended to resolve the liquidity problems of financial institutions and to restore confidence in the banking system. Banks insured by the FDIC must pay annual insurance premiums which are aligned with the bank's risk. The insurance premium paid by the banks comprise the Deposit Insurance Fund, which is regulated by the FDIC. The Financial Reform Act of 2010 requires that the Deposit Insurance Fund maintain reserves of at least 1.35% of total insured bank deposits to ensure that it always has sufficient reserves to cover losses. If reserves fall below that level, the FDIC is required to develop a restoration plan to boost reserves to that minimum level. 3 regulatory acts created more competition for bank deposits over time. In 1980, the Depository Institutions Deregulation and Monetary Control Act, DIDMCA, was enacted to deregulate the banking industry and improve monetary policy. Banks and other depository institutions were further deregulated in 1982 as a result of the Garn-St. Germain Act. One of its more important provisions permitted depository institutions to offer money market deposit accounts, or MMDAs. A second deregulatory provision of the Garn-St. Germain Act permitted depository institutions, including banks, to acquire failing institutions across geographic boundaries. In September 1994, Congress passed the Regal-Neal Interstate Banking and Branching Efficiency Act, which removed interstate branching restrictions, thereby further increasing the competition among banks for deposits and thus enabling banks to grow and achieve economies of scale. Because loans represent the key assets of commercial banks, they're regulated to limit a bank's exposure to default risk relating to highly leveraged transactions, foreign loans, loans to a single borrower, and loans to community. Banks are not allowed to use borrowed or deposited funds to purchase common stock, although they can manage stock portfolios through trust accounts that are owned by individuals. Banks can only invest in bonds that are investment-grade quality. The Banking Act of 1933, also known as the Glass-Steagall Act, separated banking and securities activities to prevent any firm that accepted deposits from underwriting stocks and bonds of corporations. The separation of securities activities from banking activities was intended to prevent potential conflicts of interest. In 1999, Congress passed the Financial Services Modernization Act, also called the Gramm-Leach-Bliley Act, which allows affiliations between banks, securities firms, and insurance companies, and also allows bank holding companies to engage in any financial activity through their ownership of subsidiaries. Banks offer a variety of off-balance sheet commitments. For example, they provide standby letters of credit to back commercial paper issued by corporations. They also act as the intermediaries on interest rate swaps and usually guarantee payments over the specified period in the event that one of the parties defaults on its payments. Credit default swaps are another type of off-balance sheet transaction that became popular during the 2004 to 2008 period as a means of protecting against the risk of default on bonds and mortgage-backed securities. As the credit crisis intensified in 2008 and 2009, regulators became concerned about credit default swaps because of the lack of transparency regarding the exposure of each commercial bank and the credibility of the counterparties on the swaps. Finally, publicly traded banks, like other publicly traded companies, are required to provide financial statements that indicate their recent financial position and performance. The Sarbanes-Oxley Act was enacted in 2002 to ensure a more transparent process for reporting on a firm's productivity and financial condition. The next major concept in the chapter is the regulation of capital. Banks are subject to capital requirements which force them to maintain a minimum amount of capital or equity as a percentage of total assets. If a bank has insufficient capital to cover losses, it will not be able to cover its expenses and will fail. Therefore, regulators closely monitor bank capital levels using the capital ratio, defined as capital divided by assets. When a bank's capital declines below the amount required by regulators, it can increase its capital ratio in a number of ways, including retaining earnings generated rather than paying out dividends to boost capital, issuing stock to the public, reducing dividends to retain a larger amount of earnings, or selling assets. When regulators of various countries develop capital requirements for their banks, they're commonly guided by the recommendations of the Basel Accord. A key provision of the Basel Accord bases the capital requirements on a bank's risk level. Banks with greater risk are required to maintain a higher level of capital, which discourages banks from taking on excessive exposure to credit risk. In 2004, a committee of central bank and regulatory authorities of numerous countries, called the Basel Committee on Banking Supervision, created a framework called Basel II, which was added to the Basel Accord. It has two major parts: revising the measurement of credit risk and explicitly accounting for operational risk. In response to the credit crisis, in 2011, the Basel Committee on Banking Supervision began to develop the Basel III framework, which attempted to correct the deficiencies of Basel II with some recommendations, including that the banks maintain Tier 1 capital amounting to at least 6% of their total risk-weighted assets, that there is a more rigorous process for identifying risk-weighted assets, the banks maintain an extra layer of Tier 1 capital of at least 2.5% of their risk-weighted assets. This is called a capital conservation buffer, and also by increasing liquidity to meet short-term cash demands. To comply with the Basel Accord, banks commonly apply a value at risk or VAR or VAR model to assess the risk of their assets and determine how much capital they should hold. VAR is defined as the estimated potential loss from its trading businesses that could result from adverse movements in market prices. Unfortunately, the VAR model was generally ineffective at detecting the risk of banks during the credit crisis. Notably, it failed to recognize the degree to which the value of bank assets such as mortgages or mortgage-backed securities could decline under adverse conditions. Some banks supplement the VAR with their own stress test. As required by the Financial Reform Act of 2010, the Federal Reserve now conducts stress tests on banks with $50 billion or more in assets on an annual basis. Banks that receive low scores must increase their capital levels and may not increase their dividends or engage in stock buybacks. The Basel Committee on Banking Supervision announced some updates and revisions to the Basel III framework with an implementation date in January 2023, which includes adoption of more standardized approaches to credit risk, operational risk, and credit valuation adjustment or CVA risk. The new revisions ask banks to use the standardized approaches to calculate capital requirements and restrict the use of IRB approaches, and revises the leverage ratio and leverage ratio buffer used by global systematically important banks, or GSIBs. Now let's look at how regulators monitor banks. Bank regulators typically conduct an on-site examination of each commercial bank at least once a year to assess the bank's compliance with existing regulations and its financial condition. The single most common cause of bank failure is poor management. Therefore, the regulators rate banks on the basis of 6 characteristics that constitute the CAMELS rating, which include capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to financial market conditions. Each of these CAMELS characteristics is rated on a 1 to 5 scale, with 1 being outstanding and 5 being poor. A composite rating is then determined as the mean rating of the 6 characteristics. Of course, any system used to detect financial problems is imperfect and therefore subject to inherent limitations, which could result in either classifying a bank as safe when it's actually failing, or classifying a bank as risky when it's actually safe. When a bank is classified as a problem bank, regulators thoroughly investigate the cause of its deterioration. Corrective action is often necessary. For example, regulators may request that a bank boost its capital level or delay its plans to expand, or require that additional financial information be provided periodically as part of ongoing monitoring. If a failing bank can't be saved, it'll be closed. The FDIC is responsible for the closure of failing banks. In these cases, it must determine whether to liquidate the failed bank's assets or to facilitate the acquisition of that bank by another bank. It may provide some financial support to facilitate the acquisition because the market value of the failed assets is less than its liabilities. The fifth learning objective relates to government actions during the credit crisis. The decision of whether to close a failing bank or facilitate its acquisition by another bank can be difficult and is sometimes controversial, especially when the U.S. government engineers an acquisition of the troubled bank in a manner that enables its shareholders to receive at least some payment for their shares. Bear Stearns was a very large securities firm that specialized in fixed income securities such as bonds and mortgages. Although not regulated like a bank, it was a major participant in the financial system because of its role as a financial intermediary and used a very high level of financial leverage. However, when Bear Stearns began to experience losses in 2007 or 2008, its financial leverage magnified the adverse impact. The Federal Reserve provided short-term loans to Bear Stearns to ensure that it had adequate liquidity. If Bear Stearns didn't meet its obligations to its counterparties on its contracts, those institutions might have experienced serious financial problems, which might have led to a string of failures and the destruction of the entire financial system. Thus, the main priority of the Federal Reserve at this time was to stabilize the financial system. Lehman Brothers, another large securities firm, also played a major role during the credit crisis. Like Bear Stearns, it wasn't regulated as a bank, but rather represented a key financial intermediary in the system. The Federal Reserve encouraged financial institutions to consider acquiring the divisions of Lehman Brothers, but did not promise any government assistance. And eventually, Lehman Brothers filed for bankruptcy. One day after Lehman Brothers filed for bankruptcy, the U.S. government took control of American International Group, or AIG, a large insurance company. The intervention by the Federal Reserve was unusual, especially because AIG is an insurance company and not regulated by the Fed. At the time, however, the government was worried about the adverse impact that AIG's failure would have had on the financial system. The government decided to rescue AIG rather than allow it to fail, so that the counterparties to these credit default swap contracts with AIG would have the backing to cover their mortgage defaults. Critics asked why some large financial institutions were bailed out but others weren't. It basically comes down to size. While Lehman Brothers had more than $600 billion in assets, AIG had more than $1 trillion in assets when it was rescued, and like Lehman, had many obligations to other financial institutions because of its credit default swap arrangements. However, one important difference between AIG and Lehman Brothers was that AIG had various subsidiaries that were financially sound at the time, and the assets in these subsidiaries served as collateral for the loans extended by the federal government to rescue AIG. The U.S. government's actions during the credit crisis were controversial at the time and have led to ongoing debate on whether and when the government should attempt to rescue failing financial institutions. One of the arguments in favor of a government rescue is that the financial problems of a large bank failure can be contagious to other banks. This so-called systemic risk occurs because of the interconnected transactions involving multiple banks. The rescue of large banks might be necessary to reduce systemic risk in the financial system. Critics of government rescues argue that when the federal government rescues a large bank, it sends a message to the banking industry that large banks will not be allowed to fail. As a result, large banks may take excessive risks without concern about failure. Some critics recommend a policy of letting the market work, meaning that no financial institution should be bailed out. In this case, managers of a troubled bank would be held accountable for their bad management because their jobs would be terminated in response to the bank's failure. In addition, shareholders would more closely monitor the bank's managers to make sure that they don't take excessive risk. The next key concept in the chapter is government funding during the crisis. One of the most important programs initiated by the government was the Troubled Asset Relief Program, or TARP, in which the Treasury injected capital into banks by purchasing their preferred stock to provide them with a cushion against their loan losses. TARP was also intended to encourage additional lending by banks and other financial institutions so that qualified firms or individuals could borrow funds. By ensuring that the banks were better capitalized, the government hoped to calm the financial market participants' fears about large bank failures that could spread throughout the financial system. The bailouts during the credit crisis led to the emergence of various groups that opposed the government's actions. In 2009, the Tea Party organized and staged protests throughout the U.S. Its members contended that the government was spending excessively, which would lead to larger budget deficits that could potentially weaken the economy further. Their proposed solution was to eliminate the government funding and bailouts of banks as one way of reducing excessive government spending. Now let's discuss the Financial Reform Act of 2010. The Financial Reform Act requires that banks and other financial institutions granting mortgages verify the income, job status, and credit history of mortgage applicants before approving mortgage applications. The Act also requires that banks and other financial institutions that sell mortgage-backed securities retain 5% of the portfolio unless it meets specific standards that reflect low risk. This provision forces financial institutions to maintain a stake in the mortgage portfolios they sell. The Reform Act also created the Financial Stability Oversight Council, which is responsible for identifying risks to financial stability in the U.S. and making recommendations that regulators can follow to reduce risks to the financial system. The Financial Reform Act gave specific regulators the authority to determine whether any particular financial institution should be liquidated. The step was intended to expedite the liquidation process and to limit losses incurred by a failing financial institution. The Act also established the Consumer Financial Protection Bureau, which is responsible for regulating consumer finance products and services offered by commercial banks and other institutions, such as online banking, checking accounts, and credit cards. The Reform Act limits proprietary trading by banks, which occurs when banks use their own funds to invest in stocks, derivative instruments, and other risky investments. This restriction is also referred to as the Volcker Rule and prohibits banks from sponsoring or holding an ownership interest in a hedge fund or private equity fund. The Reform Act requires that derivative securities be traded through a clearinghouse exchange rather than over the counter. This provision should lead to more standardized structure for margins and collateral, as well as more transparency for prices in the market. The complex set of regulators that oversee financial institutions can lead to overlapping and excessive regulation for some types of financial institutions, but very little oversight of other types of institutions. In addition, inconsistent levels of regulation among regulators may motivate some financial institutions to pursue a particular charter that enables them to avoid regulations or to allow for easier compliance. The last learning objective in the chapter relates to global bank regulations. Although the division of regulatory power between the central bank and other regulators varies among countries, each country has a system for monitoring and regulating commercial banks. The differences in regulatory restrictions may give some banks a competitive advantage in a global banking environment. The Basel III framework for increased capital requirements was intended to provide guidelines for bank regulators around the world. Many countries have taken steps to strengthen their capital requirements in accordance with the framework. Because U.S. banks conduct many transactions with European banks, some concern has risen that if a large European bank encountered problems, the U.S. financial system could be affected.